Starting a business is an exciting and challenging endeavor, but it's also fraught with potential pitfalls. One of the most critical areas where new businesses often struggle is in bookkeeping. Accurate financial records are essential for business success, as they help owners track cash flow, plan for growth, and ensure tax compliance. Unfortunately, many startups overlook or mishandle their bookkeeping, leading to errors that can be costly and even fatal to the business. In this video, we'll explore the top 10 common bookkeeping errors that kill startups and offer advice on how to avoid them. 1. Mixing personal and business finances. One of the most common and dangerous bookkeeping mistakes is mixing personal and business finances. It's tempting for new business owners to use a personal bank account or credit card for business expenses, especially when the business is just starting. However, doing so can create confusion and make it difficult to track business expenses accurately. This can lead to missed deductions, errors in tax filing, and even issues with the IRS. To avoid this mistake, open separate business accounts and use them exclusively for business transactions. 2. Failing to keep accurate records of expenses. Many entrepreneurs fail to properly track their business expenses, either by not recording every purchase or by neglecting to save receipts. Without accurate records of expenses, it becomes impossible to calculate profits correctly, and it becomes much more difficult to file taxes or prove business deductions. Even small expenses, like office supplies or meals, can add up over time. To avoid this mistake, maintain detailed records of every business-related expense, and store receipts digitally or physically in an organized manner. 3. Not reconciling bank statements regularly. Failing to reconcile business bank statements with accounting records is another common bookkeeping error. Regular bank reconciliations help identify discrepancies, such as missing transactions or unauthorized charges. If bank statements aren't reconciled frequently, financial errors can go unnoticed for months, making it more difficult to fix the problem later. Make a habit of reconciling bank statements every month to ensure that your records match up with your actual account balances. 4. Ignoring payroll taxes and withholdings. Payroll taxes are a significant responsibility for business owners, and failing to properly account for them can result in hefty fines and penalties. Many startups make the mistake of underestimating the importance of payroll taxes and fail to set aside enough money for tax withholding, Social Security, Medicare, and other required deductions. To avoid this error, ensure that you are calculating payroll taxes accurately and on time. It's also wise to use payroll software or hire a professional to help manage this process. 5. Not using accounting software. Some entrepreneurs make the mistake of manually tracking their finances without the help of accounting software. While this may work in the early stages of a business, it becomes increasingly difficult to manage as the business grows. Manual bookkeeping can lead to errors, lost information, and inefficiency. Using accounting software like QuickBooks, Xero, or FreshBooks allows you to automate many aspects of bookkeeping, reducing the risk of errors and saving time. These tools can also generate financial reports that give you valuable insights into your business's financial health. 6. Overlooking tax deadlines and payments. Another bookkeeping error that can have serious consequences is failing to pay attention to tax deadlines and payments. Missing tax filing deadlines or underpaying taxes can result in penalties, interest charges, or even an audit. Startups often struggle with this because they are focused on growing the business and may not prioritize tax obligations. To avoid this, set up reminders for tax deadlines and make sure you set aside money for tax payments on a regular basis. Consider working with a tax professional to stay on top of your obligations. 7. Not tracking cash flow effectively. Many startups focus on their sales and profits without paying enough attention to cash flow. However, cash flow is one of the most critical aspects of a business's financial health. Without proper cash flow management, a business can quickly run out of money, even if it's profitable on paper. This can lead to missed payments, unpaid bills, and other financial issues that may harm the business. To avoid this, regularly monitor your cash flow by tracking your incoming and outgoing payments. Make sure you have enough liquidity to cover expenses, especially during lean months. 8. Underestimating the importance of a budget. Many entrepreneurs don't create or stick to a budget, thinking that it's only necessary for larger businesses. However, Having a clear budget is essential for startups of all sizes. Without a budget, it's easy to overspend on unimportant items or fail to allocate enough resources to critical areas like marketing or product development. A well-crafted budget helps you make informed decisions and prioritize spending. Set realistic revenue goals and allocate your funds accordingly, adjusting the budget as necessary based on actual performance. 9. Failing to track inventory properly. For businesses that sell physical products, inventory tracking is a crucial part of bookkeeping. Failing to track inventory accurately can lead to overstocking or understocking, both of which can be damaging to the business. If inventory is not tracked properly, it can also lead to inaccuracies in financial reporting, affecting profits and tax calculations. Use inventory management software or a simple spreadsheet to keep track of stock levels, and reconcile inventory with your books regularly. 10. Not seeking professional help when needed. Finally, many startups make the mistake of thinking they can handle all their bookkeeping on their own, even when they lack the necessary expertise. While it's possible to manage finances without a professional, doing so increases the risk of making costly errors. Hiring an accountant or bookkeeper can save you time, ensure that your finances are handled correctly, and help you navigate complex financial regulations. If you can't afford a full-time employee, consider hiring a part-time professional or using outsourced bookkeeping services. Effective bookkeeping is vital to the success and longevity of any startup. Failing to keep accurate financial records, overlooking tax responsibilities, and making other bookkeeping errors can quickly derail a business and even lead to its closure. By avoiding common mistakes such as mixing personal and business finances, failing to reconcile bank statements, and neglecting cash flow management, entrepreneurs can improve their chances of long-term success. Additionally, using accounting software, tracking inventory properly, and seeking professional help when necessary will help ensure that your business stays on track. By taking a proactive approach to bookkeeping, you can protect your startup from financial troubles and focus on what matters most, growing your business.